You earn $25,000 in tips driving, delivering, or doing hair, and there is a new law that says you owe zero federal income tax on it. But there is a catch: the IRS buried in 70 pages of regulations. On July 4, 2025, a law called the One Big Beautiful Bill Act was signed. It created something called the No Tax on Tips deduction. And if you are a U.S. gig worker, a delivery driver, a hairdresser, a rideshare driver, a personal trainer, or any tipped worker in the United States, this deduction was built for you. Here is the short version. Starting with your 2025 tax return, the one you already filed or can still amend, you can deduct up to $25,000 of your tip income from your taxable income. That means the IRS does not count those tips when calculating your federal income tax bill. And by early March 2026, over 3.5 million workers had already claimed this deduction. The average tax cut was $1,300 per return. Now here is where most U.S. gig workers make their first mistake. They assume this applies to everyone who receives tips. It does not. The IRS published final regulations on April 10, 2026. Those regulations confirmed a list of over 70 specific occupations. Tipping must be customary and regular in your field as of December 31, 2024. So you cannot just start receiving tips in a new gig and claim this deduction. Here are occupations the IRS explicitly confirmed as qualifying: wait staff, bartenders, hairdressers, barbers, tattoo artists, massage therapists, personal trainers, musicians, salon workers, golf caddies, taxi drivers, water taxi operators, and critically for this audience, the IRS added app-based delivery workers explicitly. The final regulations added a new example under goods delivery people that specifically names app and platform-based delivery persons as qualifying. What about digital content creators? The IRS addressed this too. If a viewer voluntarily sends you a tip after watching your content, that qualifies. But subscription fees, platform payments, and anything the platform keeps do not qualify. Now we get to the part nobody is explaining clearly. There are 4 major catches, and if you miss any one of them, you will either lose the deduction entirely, underpay your taxes, or trigger an IRS review. Catch number 1. Self-employment tax still hits you. Every single dollar. This is the biggest trap for 1099 and gig workers. The no tax on tips. Deduction only removes federal income tax on your tips. It does not touch self-employment tax. Self-employment tax is 15.3%, and it applies to your net self-employment earnings before the tip deduction is even calculated. So let us say you are a U.S. 1099 delivery driver. You earned $20,000 in tips this year. Your federal income tax on those tips could drop to zero. But you will still owe roughly $2,830 in self-employment tax on that same income. Nobody gets out of SE tax with this deduction. Not one person. Catch number 2. Your deduction is capped at your net income from that specific gig. If you are self-employed, the IRS puts a second ceiling on this deduction. Your tip deduction cannot exceed the actual net income you earned from the tipped business. So if you earned $18,000 in tips, but your net business income was only $12,000 after expenses, your maximum deduction is $12,000, not $18,000. The remaining $6,000 in tips is still taxable. Catch number 3. High earners get phased out. This deduction starts disappearing once your modified adjusted gross income hits $150,000 for single filers or $300,000 for married couples filing jointly. For every $1,000 your income goes above that threshold, the deduction drops by $100. Once you hit $400,000 as a single filer, the deduction is gone completely. And here is something that trips people up specifically. Your MAGI is not just your tip income. It is your total modified adjusted gross income from all sources. So if you have a W-2 job on the side, a rental property, a spouse's income on a joint return, all of that counts toward the threshold. Catch number 4. This deduction expires. The no tax on tips deduction is not permanent. Congress set it to last only from tax year 2025 through tax year 2028. On December 31, 2028, it expires unless Congress votes to extend it. You have 4 years. Use them. But wait, here is the part that saves you money even if you already filed. If you filed your 2025 tax return and did not claim this deduction, you can file an amended return using Form 1040-X. Attach Schedule 1A. Claim the deduction there. The IRS is actively issuing refunds on amended returns for eligible workers. You have up to 3 years from the original filing deadline to do this. This matters because the average qualifying worker in the 22% tax bracket who earned $20,000 in tips could save $4,400 in federal income taxes. That money is sitting there. The IRS has already created the form. You just have to file it. Here is the exact process to claim this deduction correctly, whether you are filing for the first time or amending. Step 1. Confirm your occupation is on the IRS qualifying list. Go to irs.gov and search for the list of occupations that receive tips. Published under the final Treasury regulations from April 2026, your occupation must appear there. Do not assume. Check. Step 2. Calculate your qualified tips for the year. For tax year 2025 only, the IRS gave employers transition relief, meaning your W-2 or 1099 may not show tips separately. You can use your W-2 Box 7, your personal tip log, pay stubs, or your employer tip records under IRS Notice 2025-69 to calculate your total. For tax year 2026 and going forward, employers are now required to report qualified tips using a new tip code on updated US W-2 and 1099 forms. If you are self-employed, you still report total income on Schedule C, then claim the deduction separately on Schedule 1A. Step 3. Check your MAGI against the phase-out threshold. If you are single and your total income is under $150,000, you likely get the full deduction. If you are above that, calculate your reduction at $100 per $1,000 over the threshold. Step 4. Apply the net income cap if you are self-employed. Your deduction cannot exceed your net business income from the same gig where you earned the tips. Run your Schedule C first. Then compare your net income to your total qualified tips. Your deduction is the lower of the two, capped at $25,000. Step 5. File Schedule 1A with your Form 1040. The IRS released Schedule 1A in March 2026, specifically to consolidate all new deductions including the tip deduction. This is where you enter your qualified tip amount. Do not try to claim it anywhere else on your return. Do not underestimate the documentation requirement here. The IRS is watching this deduction closely. You need to be able to prove every dollar of tips you are claiming. Digital records are more defensible than handwritten notes. If you get tips through a payment app, keep your transaction history. If you get cash tips, log them daily in a spreadsheet or a tracking app. If you get tipped through a platform like DoorDash or Instacart, keep your weekly earning statements showing tip breakdowns. There is one more thing that catches people off guard. Automatic gratuities do not count. Mandatory service charges do not count. If a customer has no choice about paying it, it is not a tip under this law. Only voluntary tips count toward your deduction. And if you are married and file separately, you cannot claim this deduction at all. The law requires a joint return for married taxpayers to be eligible. Here is one more thing almost nobody is mentioning in 2026. This deduction is federal only. As of April 2026, no state has confirmed that it will conform to the federal no tax on tips rule. That means your state income tax bill is completely unaffected. You still owe state taxes on all your tip income in every state that has an income tax. So if you live in California, New York, Illinois, or any other state with income tax, your state tax bill does not change. The federal savings are real. The state savings are not guaranteed anywhere right now. Let us put this all together. If you are a gig worker who receives tips, you have a 4-year window to deduct up to $25,000 of that income from your federal tax return. At the 22% bracket, that is up to $5,500 in annual federal income tax savings. At the 12% bracket, that is up to $3,000 per year. But you have to be in a qualifying occupation, earn voluntary tips, keep documentation, stay under the income phase-out, and understand that self-employment tax still applies. And you have until December 31st, 2028. After that, unless Congress acts, every dollar of tips goes back to being fully taxable. So the time to use this deduction is now. Subscribe now. We publish tax education for U.S. gig workers and freelancers every single week, and we do not sugarcoat the catches the IRS buries in 70 pages of regulations. Hit subscribe. You just found the channel that actually reads the fine print.